Hey guys, Tony here. Welcome back. There are always raging debates and arguments on social media about if this company or that company is going to file bankruptcy. You might have seen it recently when people are arguing about AMC Entertainment. You might have seen it when people are arguing about Mullen Automotive, just two recent examples here in early 2024. And I've had a lot of discussions recently with people about what do we mean when we say do your own due diligence. For me, that means read company filings, the 10Qs, the 10Ks, the 8Ks, not for me getting my information from Twitter or Reddit or YouTube. There are certainly no shortage of opinions on many different stocks, and people are certainly entitled to their opinions, whether they're crazy bullish or crazy negative bearish. They're entitled to those opinions. They're entitled to that free speech, but listening to opinions is not due diligence. Opinions on social media can certainly be part of the information you take in. It's good, I think, to listen to both sides, and in combination with company filings and analyst report, then assemble all of this information and see what makes sense. Test out the bull thesis, test out the bear thesis, and see what you think makes sense. So in today's video, I'm going to start you off with a question. And I know if you are a CPA, you will be able to answer this. And if you are not a CPA, I hope to teach you something today. If I handed you a company's financial statements, a 10Q quarterly filing or a 10K annual filing, and I said, don't look at the income statement, don't look at the balance sheet, don't look at the cash flow statement, but look at this document and tell me if this company has impending risk of bankruptcy. What would you look at? How would you know if the company has a high probability of filing bankruptcy in the next quarter or two or within the next 12 months? If you don't know the answer to that question, stick around for a couple minutes and I will share with you one of the things that we look at when we are reading 10Qs and 10Ks. When you see people on social media saying this company is very likely to file bankruptcy, there is something hiding in plain sight on the 10Qs and 10Ks that maybe you should be aware of and add to your toolkit. Let's get right into it. I have taken a strong stance in the past when you guys ask me about different tickers where I have said, yes, this company is very likely to go bankrupt soon, or this stock price is definitely going to crash. What we're going to be talking about and showing you real life examples of today is what CPAs are very familiar with, the going concern and liquidity statement in a 10Q or a 10K. The going concern guidance comes from ASC-205-40-55-1, and it is on the CPA exam. And this is something where you don't need to be a CPA, but you need to understand what this stuff is as a very basic level of your doing your own due diligence. We're going to look at some real companies that filed bankruptcy so you can see evidence of what I'm talking about, and look at some that might have bankruptcy just around the corner, but so that you understand without having to read 40 pages, what is a going concern statement? Going concern is an accounting term that means a company has resources needed to continue operating indefinitely until it has evidence to the contrary. And companies have to look at this on a quarterly basis. And if they have any doubt about their ability to operate indefinitely, they must disclose that in a 10Q or a 10K. There is a nice pictorial flowchart that we can refer to as we try and understand what the CFO and the accounting teams at these companies look at when they are evaluating if they are a going concern or not. And we're going to be focusing on the bottom half of this flowchart, and then we'll get into some real examples, and I'll show you how this is disclosed by companies a quarter or two in advance of them actually filing Chapter 11. This is your heads up that some bad news is coming. The standard accounting is called going concern accounting. You assume that you have a going concern, that everything's fine. The first box says, is that still true? If it's not, if you need to go into liquidation accounting, then you exit on the first diamond. But if you are a going concern, if everything's fine, you move down one box to the second diamond. Are there conditions or events considered in the aggregate that raise substantial doubt about your ability to continue as a going concern within the next 12 months? So if we look forward 12 months, are you starting to have some doubt that there could be a big problem ahead? If there's not, okay, then you can exit this flowchart, continue, everything's fine. But if you have substantial doubt that there might be a problem, we move down to the next box on the flowchart. Management must consider any plans they have to mitigate any adverse conditions or events. Then we move on to the third diamond here towards the bottom of the chart. And I want you to listen to the words here. Is it probable that management's plans will be effectively implemented? If the answer is no, it's not probable that management's plans will be effectively implemented, then you go down to the gray box where you have to do a going concern disclosure. If, on the other hand, it is probable that management's plans will be effective in addressing whatever concerns there are, then we go over to the last diamond on this flowchart, and it asks, is it probable that management's plans will mitigate the relevant conditions or events? If it is not probable that management's plans will mitigate the concerns, then you go down again and you must disclose an ongoing concern footnote warning in a 10Q or 10K. If it is probable that management's plans will address all of the concerns, the final exit off to the right here is, okay, we're going to put an ongoing concern footnote in, but we're going to describe everything that we're going to do that we think will fix these concerns. Unfortunately, in today's video, the companies we're going to be talking about, and this will be quick, all of them had adverse events where it was not probable that management's plans would be effective, or it was not probable that management's plans would mitigate the concerns. So they had to disclose the ongoing concern risk. And if you paid attention to that, you had a quarter or two advance notice that Chapter 11 was around the corner. Now, I don't show you this flowchart because I want you to memorize it. You don't need to do that. What I want you to understand is that the CFO and the accounting team at these companies are looking at this. And if they end up in the bottom box here where they're having to make a going concern risk disclosure, then they are telling you, and you should pay attention to this, that it is probable that their plans will not be effectively implemented, or it is probable that even if the plans are implemented, that they will not mitigate the risk. If you get to the point where you see a going concern risk factor in a 10Q or a 10K, you should not ignore that. And if someone is telling you on social media that this company is likely to go bankrupt, they have probably looked and already seen that a going concern risk factor was listed in a recent company filing. If, on the other hand, you think someone is just being overly bearish or they're trying to scare you out of a play, then take a moment and pull up the latest filing and see if there is a going concern risk factor or footnote listed in the company's documents, because if the company sees it, they must disclose it to you. Now, we're going to start off with a shocker here. I'm going to talk about a company that has not filed bankruptcy yet, Mullen Automotive, but on page 10 of their latest 10Q, they do have a going concern footnote. It says these factors raise substantial doubt as to the company's ability to continue as a going concern. To me, that implies a very high risk of a imminent Chapter 11. Management has looked at the probabilities that they will be able to effectively implement plans, and they've looked at the probability of if those plans were implemented, would they be effective? And they came to the conclusion that no, bro, we got to go to the bottom box. We're probably not going to be successful here, and we've got to disclose that to investors. Now, you're not going to hear people talking about this on social media because it's not a comfortable thing to talk about. But management disclosed it. So if Chapter 11 happens in the next quarter or two or in 2024, management's going to be just fine. They are safe from lawsuits because they properly disclosed it. It's up to you to read it and to accept that this is a very high risk scenario. Let's look at a couple of companies that you probably have heard of that filed Chapter 11 and had the going concern warning in their documents a quarter or two before they filed Chapter 11, just so you can kind of get a feel for what I'm talking about here. The first one we are going to look at is AVCT. In their 10Q for June 30th, 2022, they listed, you can see it highlighted here, the going concern disclosure. 6 months later, in January 2023, AVCT filed for Chapter 11. Bed Bath & Beyond is our second example. In their 10Q for the quarter that ended November 2022, they had a going concern disclosure, and as we know, about 6 months later, they also filed Chapter 11. Venco Ventures, BBIG, has not filed Chapter 11, but as early as the quarter ending September 2022, they started publishing going concern risk factors in their quarterly filings. Back then, pre-split prices, it was $20. It's now trading at a fraction of a penny, 0.005 cents. Core Scientific, ticker symbol CORE, for the quarter ending September 2022. The filing was made in November, had a going concern risk factor disclosed. 1 month later, they filed for Chapter 11. Lordstown Motors, ticker symbol RIDE, RIDE, in their annual 10K filed in March of 2023, disclosed that they had substantial doubt about their ability to continue as a going concern. This was filed in March 2023. By June, they had filed Chapter 11. Troika, ticker symbol TRKA, in their 10Q for the quarter ending June 30th, 2023, announced a going concern footnote, a risk disclosure. By the end of the year, in December of 2023, Troika had filed for Chapter 11. Our final ticker that we're looking at today is Tattooed Chef, ticker symbol TTCF, for the year ending December 31st, 2022. In the 10K, they had a risk factor listing a ongoing concern risk, substantial doubt about their ability to continue as a going concern in the next 12 months. And as we know, about 6 months later, Tattooed Chef also filed for Chapter 11. Now, some of y'all like to play bankruptcy plays for volatility. This is not to discourage you necessarily from doing that. Volatility trading is one thing, but others of you are listening just to social media telling you, where are the shills at, man? There's zero chance this company's going bankrupt, when the company has disclosed a going concern risk factor that says they almost certainly are going bankrupt, but people are just not taking the time to read that for themselves, or the people on social media don't want to talk about that. Now, I know a lot of y'all are curious about AMC because a lot of you hear from the bears that AMC is at risk of imminent bankruptcy in the next quarter or so. And this is an example of the opposite of a company telling you they're going bankrupt. You see a liquidity disclosure here that says they believe, AMC believes, their existing cash and cash equivalents will be sufficient to fund the company through the next 12 months. If they did not think they had enough liquidity, they would list a going concern risk factor. This is the opposite of that. So AMC does not foresee the risk of bankruptcy due to liquidity issues like all of those other companies that we just covered. There are concerns listed in yellow here that says, hey, in the future, if box office doesn't get back up to pre-pandemic levels, well, we might have another set of problems to worry about. But over the next 12 months, which is what the going concern disclosures look at, AMC is saying they're going to be just fine. Most of us that are following AMC closely expect domestic box office, based on what we know now, in 2025 to be much better. But if you're curious about tracking this, every quarter go in and read the liquidity footnotes and see if there's any updates. And really, for any company, guys, that you're thinking about investing in or that you're invested in, especially if it is a non-profitable company, you want to go into the 10Qs every quarter and look for the liquidity footnotes or the going concern footnotes and see what the company's telling you. Because if you see an ongoing concern disclosure saying we have substantial doubt about our ability to have enough liquidity for the next 12 months, you need to pay attention to that, no matter what anybody is telling you on social media. And if the bears are on your back saying they're going bankrupt tomorrow, but the company is telling you they have enough liquidity for the next 12 months, well, you probably don't need to worry about that. At least based on the information that the company has at the moment, the next 12 months, cash are just fine. Now, before everybody gets all up in arms, remember AMC just raised a bunch of money, and that's why they're able to say that with $880 million on their balance sheet, they don't have any concerns about liquidity over the next 12 months that would require a going concern disclosure. That does not mean that we are out of the woods with future dilution risk. We're going to have to keep an eye on the cash burn, and we're going to have to keep an eye on the domestic box office, and we're going to have to be aware that if the company feels they need additional liquidity, that this statement that they have here could change on any given day throughout this next year. Companies are going to raise cash when they feel that their liquidity is drawing low, or when they're trying to manage their lenders breathing down their back with those debt covenants. Remember, if there were an ongoing concern risk disclosure here, which there is not, that is talking about the risk of bankruptcy due to running out of cash within the next 12 months. It does not preclude or prevent the company from raising additional cash through whatever means they want to use, including dilution, if they see that their cash is drawing low. It just means that, hey, we're not putting this risk disclosure here because we have tools available at our disposal to raise additional cash if we need to. I know this is a touchy topic for many people. Are they going bankrupt? Or are they not going bankrupt? He says they got enough cash, but he's still diluting. It is a complex situation to manage the working capital of a company the size of AMC. And every single week, every single month, every single quarter, the needs might change. So that's why you need to keep up with the filings, keep up with what the 10Qs are saying, keep up with the cash on the balance sheet, and make your own judgment about the risk of future dilution. At any rate, I hope you found this useful. I hope you learned something about liquidity and the going concern disclosure, the process that management must go through to decide if they have substantial doubt about their ability to survive as a going concern over the next 12 months. And I want you to look for those every quarter in the 10Qs or a 10K if you are investing in a company that is not profitable. And if you see that, I want you to pay attention to it, please. No matter what anybody tells you on social media about the next great product or the next great thing, the features, the gross margins, all of that is irrelevant if the company is disclosing an ongoing concern risk factor. There's something deeper there that you need to dig into and you need to pay attention. I'm Tony DeNaro. Thank you for watching, and I will see ya on the next video.